Welcome to Pesa Forever channel. Today we are going to do a deep dive into the world of debt mutual funds. Most people think of them as just a slightly better version of a bank fixed deposit, but as we'll see today, that's only half the story. If used correctly, debt funds can be the stable engine of your long-term financial goals.
I'll admit, for most of my life, I've just stuck my money in FDs because they feel safe. The idea of my safe money being linked to the market where prices can actually go down is a bit unnerving. What exactly is happening behind the scenes when I buy a debt fund?
It's simpler than it sounds. When you invest in a debt fund, you are essentially becoming a lender. You're lending your hard-earned money to the government, banks, or large corporations so they can build infrastructure or fund their daily operations. In return, you get paid interest. Unlike equity, where you own a piece of a company and hope it grows, here you are the creditor. You have a legal claim to get your principal back plus interest.
Okay, so if I'm the lender, why don't I just get a fixed check every month? Why does the value of my investment, the NAV, move up and down?
That's the market-linked part. Debt funds earn money in two ways. First is the interest from the bonds, often called coupon or accrual income. Second is capital appreciation. Bonds are traded on the market just like stocks. There is an inverse relationship here. When market interest rates fall, the value of existing bonds in the fund goes up, and so does your NAV. When rates rise, bond prices fall.
I've heard the term Macaulay duration thrown around in this context. It sounds like a secret code for risk. Can you explain that like I'm five?
Think of Macaulay duration as a sensitivity meter or a weighted average time it takes for you to get your money back from the bond's cash flows. If a fund has a duration of 7 years, it means it is very sensitive to interest rate changes. If interest rates rise by just 1%, a fund with a 7-year duration could see its value drop by roughly 7%. On the flip side, if rates fall, that fund gains 7%. If you need your money in 6 months, you shouldn't be in a high duration fund because a sudden rate hike could wipe out your returns just when you need the cash.
That's a huge risk for something that's supposed to be stable. So, how do I pick the right fund for the right timeline? There are so many categories.
You have to match your investment horizon to the fund's duration. For example, if you have extra cash you might need in a few days or weeks, you use overnight funds or liquid funds. Overnight funds lend money for just 24 hours, so they have almost zero risk. Liquid funds invest in instruments maturing within 91 days. They are the go-to for emergency funds because they are safer and more flexible than FDs.
What if I have a longer goal, like buying a car in 2 years?
Then you look at short duration funds. These maintain a Macaulay duration between 1 and 3 years. They aim to hold bonds until they mature, which provides more stable returns regardless of how interest rates move in the short term. If you want the absolute highest level of safety regarding your principal, you go for gilt funds. These invest at least 80% of their money in government securities. Since the government is the borrower, there is practically zero chance of a default, though they can still be volatile if interest rates change.
That's credit risk, right? That the company I lent money to just disappears?
Exactly. That's called credit risk. We saw this back in 2018 and 2019 with the ILFS and DHFL fiascos. Even some funds that were supposed to be safe took a big hit because they held bonds from these companies that were suddenly downgraded. This is why credit risk funds are tricky because they intentionally buy lower rated bonds to get higher interest rates, but it's a risky game.
I remember hearing about something called side pocketing during those crises. Did that actually help investors?
It was a vital tool. Side pocketing allows a fund manager to segregate or bad or defaulted bonds into a separate account. This stops the panic. It allows you to redeem the healthy part of your investment while the bad bonds are locked away until the fund can recover whatever money is left from the default. It protects the remaining investors from being forced to sell good assets to pay off those who are rushing for the exit.
That's a relief to know there are safeguards. But let's talk about the 2023 tax changes. Everyone says the government killed debt funds because they removed the indexation benefit. Is that true?
It definitely made things less lucrative for those in high tax brackets, but it didn't kill them. For any units bought on or after April 1, 2023, the gains are now taxed as short-term capital gains, meaning they are added to your income and taxed at your slab rate, just like FD interest. The old rule, where you paid only 20% tax with indexation after 3 years, now only applies to older investments.
So if the tax rate is the same as an FD, why wouldn't I just go back to the bank?
Because of tax deferral and set-off. In an FD, you are taxed every single year on the interest you earn. Even if you don't withdraw it, that's money leaving your account that could have been earning more money. In a debt fund, you are only taxed when you actually sell your units. This allows your money to compound much more effectively over time. Plus, if you lose money in one fund, you can set off that loss against gains in another to reduce your total tax, something you can't do with FD interest, which is taxed as income from other sources.
That's a massive technical advantage I hadn't considered. It's about the power of compounding without annual tax leakage. Now, what about the strategy of SIP versus lump sum? I thought SIPs were only for the stock market.
Not at all. An SIP in a debt fund is actually very smart, especially in a fluctuating interest rate environment. It uses rupee cost averaging. When bond prices fall, because rates are rising, your SIP buys more units. When prices rise, you buy fewer. This averages out your cost and can actually lead to better returns over 2 or 3 years. It's a great way to build a corpus for a down payment or a wedding without the stress of timing the market.
How much of my total portfolio should be in these funds? I've heard the age rule mentioned before.
The age rule is a simple starting point. Keep a percentage of your portfolio in debt equal to your age. If you're 30, keep 30% in debt. If you're 60, keep 60% in debt. As you get older, your human capital, your ability to work and earn, decreases, so you need more stability. Debt funds act as your shock absorbers. When the stock market crashes by 30%, your debt portion stays stable or even goes up, protecting your total wealth from a total wipeout.
And I should be checking this every year, rebalancing.
Absolutely. If the stock market has a great year and your equity grows to 80% of your portfolio, you sell the excess and move it into debt funds. You are effectively booking profits when the market is high and moving them into a safe harbor. This discipline forces you to buy low and sell high without having to guess what the market will do next.
This has been eye-opening. I used to think debt funds were just a complicated way to do an FD, but they are clearly a professional tool. They give me access to wholesale markets that I can't reach as an individual.
Exactly. You're getting professional fund managers to make the complex interest rate calls for you. Just remember, no investment is truly zero risk. Even safe funds have some market link. The key is to pick the right category for your timeline, check the credit quality of the bonds they hold, and always read the scheme documents carefully.
I feel much more confident now. It's about matching the sensitivity meter of the fund to the patience meter of my goals.
That's a perfect way to put it. Stable investing isn't about the highest returns every single day. It's about making sure the money is exactly where you need it, when you need it. Happy investing.